Welcome to this week's episode of Financially Speaking. As a local family-built firm, Buska Retirement Solutions, along with its affiliate companies Buska Wealth Management and Legacy Tax Solutions, offer one-stop retirement, tax, and legacy planning services to families nearing or already enjoying retirement. Sue Buska is president of Buska Retirement Solutions, a retirement planning company helping develop financial, Medicare, and health insurance strategies. Over a decade ago, she partnered with her son, Cole Bruner. Cole, an investment advisor representative that's held to a fiduciary duty, is president of Buska Wealth Management, a fee-based registered investment advisory firm providing financial planning and investment management for individuals and businesses. Legacy Tax Solutions offers personal and business tax planning and preparation services. Their enrolled agent, Carl Van Setters, is a military veteran with over 10 years of accounting experience and is committed to maximizing your tax credits wherever possible. Over the last several years, Sue and Cole have continued to grow their team of private wealth advisors to meet the increasing demand of retirees seeking guidance. In 2018, Ryan Connor began serving clients at their Eau Claire location. At their Wausau location, Logan Wooler became a part of the team in 2020. And in 2023, Sue's daughter Kaylee Berenson joined the firm. As a family-built firm with offices in Wausau and Eau Claire, their dedicated team of professionals have the experience to provide custom-tailored strategies to help you achieve your long-term financial goals. The next 30 minutes will be filled with retirement information presented by their team in a simple manner that you can understand. So stay tuned because Financially Speaking starts right now.
Is there a strategic time or way to pay taxes that can be beneficial to your retirement plan?
Today I want to talk about enhanced planning. Today, Kaylee and I are going to talk about working while drawing Social Security.
And now for our weekly question and answer segment.
Welcome back to Financially Speaking. Today I'm joined by Cole and Logan with Buska Retirement Solutions and Buska Wealth Management. We're going to be talking about planning for retirement, but before we do, if you have a question you would like to see answered, please email us at info@retirewithbuska.com. Cole, Logan, thank you so much for joining me today.
Of course.
We are going to be talking about something that I think a lot of people wonder, and is there a strategic time or way to pay taxes that can be beneficial to your retirement plan?
Sure.
So Logan, how about we start with you? How can building a strategy around when you pay taxes help your retirement plan?
Yeah, so we don't have the decision if we pay taxes on our money. You can not do that, but now you're up for fines or jail time, so I'd recommend paying your taxes. But there is strategies, But there are definitely strategies of how and when you pay those taxes, and we want to utilize those as much as possible. Because it's based on tax brackets, right? So we have our yearly income taxes, and that can dictate what way we want to save and into what places to make sure that we can, take advantage of those tax advantages.
Right. Yeah, absolutely. Well, and one of the things that we preach about all the time, and we've talked about it in previous episodes, but I think it bears saying again, there's more to diversification than just diversifying your investments, right? We've heard a million times over our life, don't put all of your eggs in one basket, right? That is absolutely true and very applicable to financial planning. But I think a lot of people kind of pigeonhole that as don't put all of your money in one stock, right? Or don't put all of your money in one mutual fund. You want to spread those funds out into multiple different places so that you're well covered when it comes to your diversification of your portfolio. But we also want to consider tax diversification. There's three possible buckets of money you could have in your portfolio from a tax perspective. There's your taxed now bucket, where you pay taxes on your gains every year. And then you've got your taxed later bucket, which for most people is their largest bucket. That's things like IRAs, 401ks, all that pre-tax money that we've been putting money away for retirement into. And then you've got your taxed never bucket, essentially, your tax-free bucket, which would be Roth. Some various life insurance tools could fall into that bucket. So you want to make sure that you're not only diversifying amongst your investment choices, but you're also diversifying amongst those taxation buckets, if you will, because it's going to give you more control, especially if legislation change comes into play. Or if the government raises taxes at some point in the future, it's going to give you the ability to try to mitigate some of that extra taxation that you'll have to deal with in the future.
So let's dig into that a little bit deeper. What are some of the products, Logan, that are taxed now?
Tax now, so that could be anything from your bank accounts, even though they don't have the interest rates that they used to, but you'll still get a tax document come January where you'll see your $5 of growth throughout the year. So that's going to be a tax now. It can be investment accounts where you're just putting non-qualified money in and then you're realizing those gains throughout the year. CDs, when they come due in that year, can be a taxable event too. So it's going to be products typically through a bank or a non-qualified investment account.
Yep. Essentially, any money that you've already paid tax on the principal balance of, and you've invested that, now the growth of those funds is going to be taxable out into the future.
And what about the products that are going to be taxed later?
Well, that would be things like your 401k, pre-tax money in your 401k, 403b, 457b that's pre-tax, traditional IRAs, simples, SEPs, all of those types of things. And basically anything that you put into a retirement account and took a tax deduction for is going to be taxable at some point in the future when you start to make withdrawals from those accounts. And of course, with those accounts, the government mandates when you have to start taking money out because, of course, they want their share at some point in the future.
And what about the last bucket? You said tax-free.
Yeah.
What are some of those products that qualify for tax-free distributions or withdrawals?
Yeah, the biggest bucket there is going to be your life insurance. And that's where we really get into a lot of strategies and opportunities to not only have that tax-free distribution or withdrawal, but also strategies to help in other ways, whether it's protecting assets or dealing with long-term care or getting more income later in retirement. So the biggest bucket there is life insurance.
Yeah, Roth IRAs are also a big part of that tax-free bucket. We've talked many times in the past about Roth conversions and all of these things. And, that's definitely a more common phrase nowadays because I think people are more proactively looking at ways to make more of their portfolio tax-free. So we've talked a lot about Roth conversions over the last several years, making sure people understand the importance of putting money into Roth IRAs. Because of course, the idea that a retiree will always be in a lower tax bracket in retirement than they were when they were working is possibly a myth for some people because we find lots of clients that wind up in the same, if not maybe even a higher tax bracket in retirement because they've designed their lifestyle based on that amount of income. And if they still need that level of income in retirement, they could find themselves in that same tax bracket. So really all they're doing is deferring that obligation to the future. And we always kind of refer to that as kicking the can down the road to the unknown because if we could pay 12% taxes on those funds today and then grow them tax-free into the future in something like a Roth versus taking a deduction of that 12% tax liability, waiting until 10 or 15 years from now to pay them, and now all of a sudden that 12 is 17%. Have we really saved ourselves money in the long term? Probably not in that particular example. Now, granted, that's a very, generic example, but it does help people's minds think about the fact that we may not always be in a lower tax bracket in the future. And so it could possibly make sense for us to pay some of those taxes now so that that money can grow and defer into the future in a tax-free status.
And always doing your best to understand where your income streams are coming from.
Absolutely.
Because with retirees now, because of advancements in health and technology, they're living longer, where I think retirement before was sought after or looked upon as, hey, I got free time now, I'm just going to relax, visit friends and family. But now, being that people are living longer, there's part-time jobs that are coming into the equation. Pensions are still coming in and have a certain tax burden with them. So also understanding where your income streams are coming from goes back to we might not be in the lower tax bracket when we are in retirement. It would be the same, sometimes higher.
Absolutely.
So who can help me come up with a strategic plan?
Oh boy, that's a tough question there, Christina. Obviously, a financial professional. you want to make sure that you're working with a financial professional. I mean, from our perspective, we want to see people working with fiduciaries, obviously, independent, so they're not being skewed by, pushing certain recommendations or products or things like that. And just working with a financial professional that can really take that comprehensive approach. I think when we think financial professional, often clients paint everybody with the same brush. And one of the things that's unique to our company specifically is the fact that we do more than just help you to pick your investments. I mean, a lot of people, when they think financial professional, they think they're going to tell me where to put my money, right? Yes, that very much is a part of that role. But at the same time, you want somebody or a team of professionals that's going to be able to help you to answer questions related to your health insurance cost, Medicare options, tax planning, estate planning, wills, trusts, all of these things all interconnect when it comes to our financial plan. We look at retirement as kind of like a big puzzle, right? And when we do a puzzle, I'm sure most people have done a puzzle at some point in their life, you get a picture of what the picture on the puzzle is going to look like at the end. So it gives you an idea of where each of those little pieces will fit, right? Retirement planning is no different. You get all of these pieces laid out in front of you, but unfortunately there's no box that tells you what it looks like at the end, right? So you've got to figure out what that looks like yourself and figure out how all of these pieces fit together in the right way. So it's going to provide you with the most well-rounded plan for your specific circumstances. And that's obviously where an independent fiduciary financial advisor can really help to become that quarterback, to help you to understand where any of those weaknesses may lie and figure out how those puzzle pieces fit together in the best way possible so that you can enjoy your quality retirement you're hoping for.
Yeah, and knowing the goals, wants, needs, and interests of people.
Yeah.
Because what Cole had talked about is definitely important stuff, but based on what your lifestyle is going to be like, we want to dig into that too. Even your health. We want to be able to cover those type of situations, the what-if situations that could come up. So really digging into goals, wants, needs, interests is very valuable too. That sometimes gets missed. So we like to dive into that too.
Absolutely.
That's all part of the strategy.
That's right. Absolutely.
Well, thank you both for joining me today, and thank you for watching Financially Speaking. We'll be back with more right after this.
Close your eyes and picture retirement for a moment. What does your dream look like? Would your days be filled spending time with family and friends? Maybe you desire to volunteer or work a rewarding part-time job. Or do you envision traveling the world? Whatever your dream consists of, Buska Retirement Solutions can help you realize it. Call or go online to schedule a complimentary consultation today.
And now, our Financially Speaking weekly topic segment.
Welcome back to Financially Speaking. I'm Cole Bruner from Buska Retirement Solutions and Buska Wealth Management. Today I want to talk about enhanced planning. Enhanced planning is the process of managing and preserving your assets while you're alive and conserving and controlling their distribution after your death. There are 4 key enhanced planning documents almost everyone should have regardless of age, health, or wealth. They are a durable power of attorney, advanced medical directives, a will, and a letter of instruction. First, let's talk about a durable power of attorney. Incapacity can happen to anyone at any time, but your risk generally increases as you grow older. Consider what would happen if, for example, you were unable to make your decisions or conduct your own affairs. Failing to plan may mean a court would have to appoint a guardian, and the guardian might make decisions that would be different from what you would have wanted. A durable power of attorney, or DPOA, enables you to authorize a family member or other trusted individual to make financial decisions or transact business on your behalf, even if you become incapacitated. The designated individual can do things like pay everyday expenses, collect benefits, watch over your investments, and also file taxes. There are 2 types of DPOAs. The first is an immediate DPOA, which is effective at once, and this may be appropriate, for example, if you face a serious operation or illness. And the second is a springing DPOA, which is not effective unless you become incapacitated. Now next, let's go over advanced medical directives. An advanced medical directive lets others know what forms of medical treatment you prefer and enables you to designate someone to make medical decisions for you in the event that you can't express your own wishes. If you don't have advanced medical directives, healthcare providers could use unwanted treatments and procedures to prolong your life at any cost. Now, there are 3 types of advanced medical directives. Each state only allows a certain type or types. You may find that 1, 2, or all 3 types are necessary to carry out all of your wishes for medical treatment. A living will is a document that specifies the types of medical treatment you would want or not want in a particular situation. In most states, a living will takes effect only under certain circumstances, such as terminal illness or injury. Generally, one can be used solely to decline medical treatment that serves only to postpone the moment of death. A healthcare proxy lets one or more family members or trusted individuals make medical decisions for you. You decide how much power your representative will have or won't have. A do not resuscitate or DNR order is a legal form signed by both you and your doctor that gives healthcare professionals permission to carry out your wishes. Now, let's talk about the enhanced planning document that you're probably most familiar with, the will. A will is quite often the cornerstone of an enhanced plan. It is a formal legal document that directs how your property is to be distributed when you pass. Your will should generally be written, signed by you, and witnessed. If you don't leave a will, disbursements will be made according to state law, which might not be what you would have wanted. There are a couple of other important purposes for a will. It allows you to name an executor to carry out your wishes, as specified in the will, and a guardian for your minor children. Now, most wills have to be filed with the probate court. The executor collects assets, pays debts and taxes owed, and distributes any remaining property to the rightful heirs. The rules vary from state to state, but in some states, smaller estates are exempt from probate or qualify for an expedited process. Now, finally, let's go over the letter of instruction. A letter of instruction is an informal, non-legal document that generally accompanies a will and is used to express your personal thoughts and directions regarding what is in the will or about other things, such as your burial wishes or where to locate other documents. This can be the most helpful document you leave for your family members and your executor. Now, unlike your will, a letter of instruction remains private. Therefore, it is an opportunity to say the things that you would rather not make public. A letter of instruction is not a substitute for a will. Any directions you include in the letter are only suggestions and are not binding. The people to whom you address the letter may follow or disregard any instructions. Life is unpredictable, so make sure you're taking steps now while you can to have the proper documents in place to ensure that your wishes are carried out. If you're ready to tackle your enhanced plan and you want to discuss how it fits into your retirement and financial plans, be sure to contact our office today at retirewithbuska.com or call us at 715-355-4445. We'll be right back with more Financially Speaking after this.
And now our Financially Speaking weekly desk segment.
Welcome back to Financially Speaking. I'm Cole Bruner with Buska Wealth Management and Buska Retirement Solutions, and joining me today is my sister Kaylee Berenson. Today, Kaylee and I are going to talk about working while drawing Social Security.
That's right, Cole, and we'll discuss how much you can earn from work before it impacts your benefits and what happens to your benefits if your earnings go over the limit.
So first, let's address the short answer to this question. Can you work while you're taking Social Security?
Yes.
Okay. Well, that's now what's the longer version?
The longer version is that it's complicated. You can work while you collect Social Security, but there is a limit to how much you can earn from working. If you go over that limit, your benefit will be reduced.
Now, an AARP article titled "Can I Work and Still Get Social Security" covers this pretty extensively for us.
First, note that if you're younger than full retirement age, there's a limit on how much you can earn from working.
That's right. If you've reached full retirement age, then there's no limit to how much you can earn from working.
The full retirement age is 67 for people who were born in 1960 or later.
All right, so if you're below full retirement age but have filed for benefits, how much can you earn from working before it counts against your benefits?
For each $2 over the limit of $22,320, the federal government will deduct $1 from your Social Security benefits.
Okay, well those numbers are for 2024, right?
That is correct.
Well, if you reach full retirement age in 2024, the feds will deduct $1 from your benefit for every $3 you earn over $59,520.
So what happens if you go over the limit and they have to deduct your benefits? Do they come to your house with a piggy bank and demand that you fill it?
Well, I think you know that's not how it works. What they do is they withhold your benefits for a few months. In the Social Security pamphlet titled How Work Affects Your Benefits, they give this example. I'm just going to read from the pamphlet. It says, let's say that you file for Social Security benefits at age 62 in January 2024, and your payment will be $600 per month or $7,200 for the year. During 2024, you plan to work and earn $24,920, which is $2,600 above the $22,320 limit. We would withhold $1,300 of your Social Security benefits, $1 for every $2 you earn over the limit. To do this, we would withhold all benefit payments from January 2024 through March 2024. Beginning in April 2024, you would receive your $600 benefit, and this amount would be paid to you each month for the remainder of the year. In 2025, we would pay you the additional $500 we withheld in March of 2024.
That's a little clearer.
For sure. Now, additionally, when you reach full retirement age, they pay you back the money that they withheld.
And if you have a spouse or children who receive benefits based on your work record, they will also experience a reduction in benefits if your earnings from work go over that limit.
That's right. And if you or your spouse or your children work, their incomes are also subject to that earnings cap.
Next, you should note that if you work and collect Social Security benefits, you may have to pay a hefty tax bill. Increasing your withholdings can help you avoid this.
That's right. Now, lastly, the earnings cap doesn't apply to things like capital gains, pensions, annuities, or investment income.
That's all important information, Cole. Now, before we move on from this subject, there's one last thing that I'd like to clear up.
And what is that, Kaylee?
It says that the earnings cap goes away when you hit full retirement age.
Right.
So does that mean that you have to wait until full retirement age to be able to file and draw benefits and work without being subject to that earnings cap? Or can you file before full retirement age, work, and then have the earnings cap go away once you reach full retirement age?
Well, you can claim benefits at age 62, keep working, and be subject to the earnings cap until you reach full retirement age. In other words, you can work all that time, and when you reach full retirement age, that cap goes away.
So you do not have to wait until full retirement age to file to be subject to the earnings cap.
That's right. That's a really good question, and I'm sure a lot of our viewers were wondering the same thing out there.
Yeah, and most of the time when we talk about full retirement age, we're talking about waiting to reach that age so you can claim your full benefit. So it's only natural for somebody to think that waiting applies in this instance too.
It's just like you said, it's complicated.
That's why it can be so helpful to talk to a financial services professional before you make decisions about your Social Security.
Absolutely, and we can help you understand your options and examine your financial situation to determine when it's a good time to file, whether you should keep working, and all of that other good stuff.
Now, what if your income from working is above the earnings cap? Do you have to let the Social Security Administration know?
Well, according to another AARP article titled, "Do I Need to Notify Social Security If I Am Receiving Benefits and Earn More Than the Annual Earnings Limit?" the answer is yes.
You mean the SSA doesn't send out drones to follow claimants around to see whether they're working too much?
No, you have to tell them promptly if you're over the earnings cap. If they send more money than you're supposed to get, you have to pay it back, or you could face a penalty.
What if I'm self-employed?
Well, the earnings cap will still apply.
So if you're working while claiming Social Security benefits, is it even worth it? I mean, you have to notify them, pay them back if they send you too much. It seems like a hassle, doesn't it?
I definitely see where you're coming from, Kaylee. And while these administrative tasks may seem like a pain, in my opinion, they're not so difficult to deal with if you stay on top of them. If continuing to work while claiming benefits helps you reach your financial goals, then these little bureaucratic things may be worth putting up with.
Fair enough.
Kaylee, did you see the article in USA Today titled "The Single Worst Reason to Claim Social Security Early"?
I did see that article, and it says only 10% of Americans plan to wait until age 70 to claim their Social Security.
That's right. That means 90% of people are leaving a lot of money on the table, possibly.
It sure does. And according to the article, people plan to claim early because they're worried that Social Security won't be around for them.
Right. 44% of people feel that Social Security will run out before they retire.
It's not an unreasonable fear. We hear a lot about how Social Security is running out of money, but is it true?
I love this quote from the article. Despite the popular belief, Social Security is not in danger of running out of money. It has a steady revenue stream that comes from current workers' payroll taxes. This is not going to stop happening unless everyone in the U.S. stops working or unless the funding mechanism is changed, which is extremely unlikely to occur.
That's a great quote, and it could help folks breathe a little easier. The article goes on to point out that while the Social Security Trust Fund is in danger of running dry by 2033, it doesn't mean that there won't be any benefits. There's still money coming in from tax revenue to cover about 77% of promised benefits.
So people could get less, but they certainly won't end up getting nothing.
Right.
Now, do you think that Social Security benefits will take a hit, or will something be done before that happens?
In my opinion, no politician wants to be the one to tell his or her constituents that they're getting a smaller benefit payment. An article in U.S. News and World Report titled "Why Older Citizens Are More Likely to Vote" says voter turnout among people aged 65 and older is 71.9%. That's by far the highest percentage. So I believe no politician wants to upset the people who are most likely to vote.
So you think some sort of policy change will take place before cuts to Social Security do?
I don't have a crystal ball, so I don't know the future, but I think it's highly likely that policymakers will do something. In my opinion, alienating a big voter bloc by cutting their benefits would be a high-speed exit ramp right out of the public office. I don't think that's a risk that they want to put themselves on that ramp.
I think you might be right, Kaylee. Well, we're about out of time for today. If you'd like to talk to us about how income from working impacts your Social Security benefits or about when to file, contact our office today at retirewithbuska.com or call 715-355-4445. We'll be right back with more of Financially Speaking after this.
Thank you for tuning into this week's edition of Financially Speaking. We're glad you were able to join us today, and we hope you learned some useful retirement tips along the way.
On today's show, we covered a number of important topics, and hopefully we did so in a manner that was easy for you to understand. This is the same way that we communicate to our clients when we meet with them in person. Remember, with the help of the right financial services professional, you can create a quality retirement, and our team of advisors is here to help. Right now may be a great time to get a second opinion on your current retirement plan. So call us at 715-355-4445 or go to retirewithbuska.com to continue your retirement education, catch up on some previous episodes of our TV and radio shows, or to schedule that complimentary, no obligation consultation.
If you have any questions or comments about today's show, call us at 715-355-4445 or feel free to send us an email at info@retirewithbuska.com. Join us next week at the same time and the same place for another episode of Financially Speaking.